Hello, I'm Peter Herbert and welcome to this latest in our series of short CPD webinars looking at topical aspects of financial reporting, auditing and company law. Today's session is going to look at the very topical issue of environmental, social and governance, or ESG reporting. Here's the programme for the session. We're going to start off with a quick overview of what ESG reporting is all about and some of the related legislation. We're going to drill down onto particularly pertinent aspects for the firms and companies that we work with, which is Section 172 reporting and SECA reporting, and finish off with some considerations about the back-end reporting implications, i.e. the implications of all this sort of stuff for the financial statements, which we'll do at the end of today's short session. Okay, let's begin then with a chat about what it's all about. ESG reporting has got a number of drivers. I guess in part that's government policy. That's also in part the big and increasing investor and consumer focus on environmental, social and governance issues. I suppose in a sense the social and governance aspects of ESG are reasonably well developed. What of course is increasingly to the fore and evolving all the time in the light of COP26 is the requirements for transparency and disclosure around environmental policy and environmental behaviour. This slide summarises the fact that in the UK alone, there's a whole plethora of legislation and regulation that affects reporting in this area. Let me highlight a couple of points, if I may. First of all, Companies Act. So there are changes to the Companies Act in recent years that have embraced specific aspects of ESG reporting. We're going to look in a bit more detail shortly about how the Companies Act deals with Section 172 reporting and how it deals with reporting in relation to streamlined energy and carbon emissions reporting. The ISSB, the International Sustainability Standards Board, is also worth a mention. This was an organisation formed only a month or so ago and will now sit alongside the International Accounting Standards Board. I think there's a recognition that we probably need to have some sort of global standards and some global consistency really in the way that corporates explain particularly their environmental performance and objectives and metrics, and the ISSB will sit alongside the ASB to develop some standard rules and conventions really in terms of the way that environmental activity is reported within organisations. It'll impact on the largest companies clearly in the first instance, but one to keep an eye on certainly in terms of organisations that are a bit smaller as well. And in that regard, also worth flagging up here, the Task Force on Climate-Related Financial Disclosure. This is an organisation which has created a list of around about 11 sort of required disclosures in relation to corporates in the area of climate-related activity under four main pillars. So what do the corporates do in relation to governance in this area? What do they do in terms of strategy? What do they do in terms of risk assessment and risk management? And what are the key metrics that they use to measure performance? Now, for 31 December 21 year ends, it'll be a requirement for all premium listed companies to explain in their narrative report how they actually perform against the 11 sort of measures they're established by the TCFD around those four pillars of disclosure. And that'll be required on a comply or explain basis, either incorporate information about how you embrace TCFD or explain why you're not doing that. Now, the organisations that we work with, very few of them have any real exposure to that very large premium listed company arena. There has been legislation put up for approval, which will, for periods commencing 6th of April 22, roll out that requirement for disclosure around the TCFD requirements and apply it to listed companies generally, public interest entities generally, and large companies generally, that being defined for this purpose as those with more than 500 employees and with turnover of more than 500 million. So still very large organisations, but it just gives you a sense really of the direction of travel as far as this whole environmental disclosure aspect is concerned. It will broaden out, obviously at the current time, with that requirement for disclosure limited to the premium listed companies. It's still quite narrow, but it will broaden out a lot, I'm sure, in the months and years to come. For anyone interested in getting a bit more under the skin of what the TCFD disclosure requirements are really all about, the Financial Reporting Council published a very useful lab report back in October with a bit of an explanation. As you'll see on this slide, this is an extract from that lab report. Only 204 organisations during 2021 have made specific and extensive reference to TCFD and the manual reports. Obviously, it's still fairly niche at this stage, but with that requirement growing based on the needs for all premium listed companies for 31 December 21 year ends, and that rolling out going forward, this will only be an area of greater disclosure. And with that in mind, I suppose the FRC Lab Report, I would say, is a useful read. Right, okay, let's then drill down on a couple of specific areas which are probably a bit close to home for a lot of the organisations that we work with, beginning with Section 172 reporting. This is required now, isn't it, for all companies that are large based on company law. So broadly speaking, where you've reached 2 out of 3 of turnover 36 million, gross assets 18 million, and employee numbers 250. It's been around for a while. Here's a snapshot summary of what's required. So how the directors have fulfilled their duties under Section 172 of the Companies Act to promote the success of the company for the benefit of the members, but along the way having an eye to a number of considerations, ESG amongst those, and also specifically the needs and requirements of stakeholders like customers, like suppliers, and employees as well. Now that Section 172 statement, as well as appearing within the strategic report, will also need to appear on the company's website. And don't forget that there are specific disclosure requirements as well in the director's report in relation to engagement. So how is the organization engaged with its employees? How is it engaged with its suppliers? How is it engaged with its customers? And how has that engagement then driven the strategy of the organization during the course of the year? Now that employee engagement statement, we probably see more than any else. That's required for any organization with more than 250 employees. So you might be medium-sized or even small based on turnover or gross assets. But if you reach 250 employees, that employee engagement statement will be required, and the default place for that would be the director's report. One other point to mention in the context of Section 172 requirements, which has caught a few organisations out, where you are an ineligible company by virtue of being a certain organisation in the financial services space, or perhaps by virtue of being an unlisted PLC, you have to deal with this as well in your annual report. If you're ineligible, you cannot use the small company exemptions, you cannot use the medium-sized company exemptions, you're automatically large, and therefore the Section 172 requirements, they would apply to you as well. That's quite a number of ineligible companies out over the last year or so. That again, I suppose, something which we need to make a reference to here on today's short session. Again, in terms of guidance, the FRC have issued a very good lab report a couple of months ago, all about Section 172. It's a very good read. Again, if you're working within professional practice, a very good and short, succinct paper to share with clients to get them up the curve as far as Section 172 is concerned. The key thing to my mind here, it's just really reinforcing the idea that the Section 172 statement is not in any way, shape, or form a statement of compliance. And it's all about explaining really how the board's considered the interests of all those key stakeholders and how that actually has informed the strategy during the course of the year. And that, to me, certainly has been a big bugbear, which is why I'm regularly referring people to that lab report statement. It's useful and gets people on track, really, as to what's required. I thought it might be worth sharing an example that I came across earlier this year. I would call this probably a weaker example of an employee engagement statement. This was one for a medium-sized company that had more than 250 employees, owner-managed. The company provides employees with information on matters of concern to them as employees or their representatives on a regular basis, so that views of employees can be taken into account in making decisions which are likely to affect their interests. But that does not in any way, shape, or form tell me how the organisation engages with employees and how that actually then drives the strategy. So that's the typical of the sort of boilerplate disclosure that we might expect to see. We would really look for more where an organisation concerned was within scope. And I guess to a degree that also reflects not particularly well on the audit firm as well. Remember that when it comes to narrative reports these days, what auditors need to do is, as well as checking to make sure that narrative reports are consistent with the accounts, they've also got to be comfortable that they are complying with relevant legislation. And if this report does therefore not really do the job, it reflects badly on the company, and I suppose as well badly on the audit firm for not having been more robust in their dealings to make sure that the disclosure in the case here was better. Okay, let's move on to streamlined energy and carbon reporting. Now again, it's been around for a while. This would again apply to large companies. I've already mentioned the thresholds for large, reaching 2 out of 3 of the limits on this slide. I guess the key thing to bear in mind in terms of the streamlined energy and carbon reporting regulations, though, is this does not apply where a company is ineligible by virtue of being a PLC or a financial services business. It's very much based, this one, on whether you breach 2 out of 3 of the relevant limits. Now, there are various requirements. I suppose I would probably highlight 4. First of all, you are required to articulate energy consumption. Very important to be clear here that this is all about UK and offshore, not overseas consumption. And again, we've come across a number of organisations where they've got a very large overseas presence, a relatively limited UK presence. And yes, whilst you can choose to incorporate global disclosures here, there's no obligation. And I guess in that sense, I suppose, therein lies the benefit going forward of some more standardized international rules here. And that may well be where the ISSB comes into its own. So energy consumption, and then moving on from there, details around carbon emissions. Now, as you may recall, that's then broken down by what we call individual scope. So that's fuel which has been combusted by the company, either through its own generators or through its own vehicles. Scope 2 is where you purchase electricity and purchase gas, let's say from the national grid. That's therefore purchased, not generated electricity on the part and gas on the part of the company concerned. And then scope 3 emissions are those from business travel in rental cars or employee owned vehicles, where the company is responsible for purchasing the fuel. So first of all, the consumption. Secondly, the related carbon emissions. And then thirdly, again, you've got this intensity ratio disclosure requirement where you're required to actually say, what does that mean in terms of, for example, carbon emissions per, as in the illustration here, per £100,000 of revenue, carbon emissions per employee. So any appropriate intensity ratio will do, but there needs to be a disclosure around that. The methodology, i.e. the way in which the figures have been derived, and then beyond that, steps taken to improve energy efficiency, all requirements for disclosure there as far as the legislation is concerned. Now, there are exemptions. I've mentioned a number of the key ones on this slide. The one I suppose we get most questions on tends to be the top one. So if you're a low energy user consuming less than 40 megawatt hours or 40,000 kilowatt hours in an overall reporting period, there's no requirement to incorporate the relevant disclosures there. What I regularly hear and regularly read is that 40 megawatt hours over a 12-month reporting period is not a lot of energy. So you need to be a very, very, very low energy user to fall below that threshold, and therefore for these disclosure requirements not to apply. Now, here's an example. This is taken from a set of accounts. I was recently looking at the accounts of Lush Cosmetics PLC for their year end June 30th, 2020. Yeah, and I suppose things that interest me with this particular disclosure, we've got actually 4 years worth of detail here. So what have we got? 4 years worth of comparatives plus the additional year itself, 1920. Now, again, I think as far as the initial year is concerned, there's no particular obligation to go back as long and as far back as they've done, but they've obviously tried to incorporate some information to sort of build it up from 15, 16 through to 1920. What I think seems to be missing here, to my mind, is a lack of analysis of emissions by individual scope. We mentioned, didn't we, a minute ago, scope 1, scope 2, scope 3. So they've gone back further than they need to, but they've not analysed it out in the way the SECA requirements would actually apply. I suppose just in terms of this disclosure and disclosure requirements more generally in this area, I think people do often sort of feel that sometimes the cost of obtaining the information to put the relevant table together to some degree probably would currently at least exceed the benefit. The table just sits there, and for a lot of people there's not a huge amount of value, but the requirement is there. So again, if you are breaching 2 out of 3 of those limits, it is important to make sure the disclosure is in place. We've been getting a lot of questions currently from people about, well, if I've got a situation where I am, consuming or emitting 2,695 tons of carbon emission, is that a good performance? Is that a middling performance? Is that a bad performance? I suppose lack of ease of comparability is a challenge currently. But again, I guess if you're an analyst, a reader of accounts, very much focused on this sort of stuff, you could go and look at similar companies to compare their stats with the stats of the company concerned here. But I guess, yeah, comparability is challenging if this information is new. And again, I suppose also in the context of a lot of people, the question would be, well, how far would the auditor need to go? I think to my mind, the auditor would need to have a cursory glance at the information, make sure it is reasonable. Again, going back to the point from 3 minutes ago, you are there to ensure the information complies with the relevant legislation, as well as being consistent with the accounts. But I guess to my mind, it might be a slightly lighter touch in the sense that you're not giving an opinion on the truth and fairness of the information in the same way that you are the information in the financial statements. But let's be really clear about it. This sort of information will become more and more important to more and more readers and users of the accounts going forward. It may be that these sort of stats inform whether others are willing to invest in a company. It may well inform customer relationships and customer perceptions. It might ultimately therefore inform the viability of the organization itself. So we're early on the journey here, but this will only become more important as time goes on. One final point before we finish off with a different area. The Financial Reporting Council's annual corporate reporting review was published back in October 21. And for those that are already looking at this information, producing this information, reviewing this information, some quite interesting feedback points from the FRC in their corporate reporting review paper around what they felt their conclusions have been on disclosure in the area of SECA, based on a sort of a thematic review they did earlier in 2021. General feedback was positive, organizations generally compliant, but there were some tweaks they were looking for. I guess in particular, 1 or 2 areas which they felt had arisen in the first year. And I think, again, going back to that Lush cosmetic example, to me, that feels like it needs a bit more granular information about emissions by scope, and a little bit more explanation in places of why particular intensity ratios were used, and a little bit more integration with narrative. But a generally fairly positive feedback from the FRC. So if you are interested in getting a bit more underneath that, do look at the corporate reporting review paper linked to on this slide, and do look at the FRC thematic review, which again, the corporate reporting review paper would feed into and link to as well. Okay, let's finish off then with a few thoughts about the back-end reporting implications of some of the stuff we've been talking about here, particularly in relation to the sort of the environmental stuff and SECA. I guess fundamentally, when it comes to the sort of these cutting edge issues, very often the narrative report at the front of the annual financial statements will lead the way in terms of the detail. I guess the implications will be there for the back end when these sort of issues start to impact organizations operationally. But there will be implications to come, and the next slide summarizes a few of the important ones to be aware of down the line. We're already hearing organizations telling us that when they were approaching banks for funding, they're being told, going forward, when you pay interest, the interest that you will pay will be linked to your carbon emissions. So very interesting insight there, whereby the information on the previous section in terms of carbon emissions and environmental performance directly links to the amount of interest that an organization will pay. Now, would that then be a basic or non-basic loan per FRS 102? Probably non-basic, but not something I'm sure FRS 102 would ever have given consideration to. when FRS 102 was first produced way back in 2015. We're already being told by some of our industry clients that when they're doing things like impairment reviews and cash flow models, they need to think, that's what their auditors are telling them at least, about how environmental strategy and the positive and negative impact that has on the organization going forward, being asked to really think about how that would play into cash flow models for the purpose of going concern justifications and for the purpose of impairment reviews, value and use calculations. So that's something, again, which is already affecting some organizations based on the dialogue they're having with their auditors. Some organizations where they operate in particular sectors, the impending changes down the line can only impact in terms of shortening things like useful economic lives of fixed assets, can only impact perhaps in terms of reducing residual values. I'm thinking there about organizations like hauliers. So that will be something which may not be happening right now, but it's not going to be so far off when those environmental issues will impact certainly on useful lives of fixed assets. That in turn might mean that certain assets might become obsolete or unsaleable, which impacts obviously in turn therefore on impairments. What about situations where customers have not got a very good environmental strategy? That's impacting on their business model adversely, and that might impact on their ability to pay a company that you're actually working within or acting for. So impairment of receivables scale as well could be an issue where customers are impacted adversely by some of the environmental changes going on at the current time. Organizations might be investing. That might mean important implications in terms of accounting for R&D costs. It might be in certain industries which perhaps have got polluting assets. There are assets that need to be retired or decommissioned, and that might have implications in terms of things like decommissioning provisions. It might be in terms of moving the business forward, and again, the link here to R&D, there's government grants available. Again, the accounting there is going to have to be carefully thought through in terms of FRS 102. It might even be that what organizations are doing is looking to remunerate people in the organization and offer share options within the organization based on what they do to really drive the organization's environmental agenda. So again, to what extent will that impact on the valuation of share-based payments for accounting purposes under, for example, FRS 102? When environmental performance impacts on trading profit, that impacts obviously on current tax, might also impact on deferred tax. If an organization is investing in kit that might attract very high capital allowances in the early years by virtue of being environmentally friendly, that could impact on big accelerated capital allowances. Again, if the organization concern's not really switched on to the environmental agenda, and actually the prospect of pretty poor going forward for that organization as a result, does that possibly mean that deferred tax assets in relation to losses that have been carried forward over a number of years are no longer deemed to be recoverable? And we do sporadically get questions about things like green bonds, carbon offsetting schemes, emissions trading schemes, where there's no specific rules in relation to FRS 102 that deal with these. They're increasingly common issues. And again, it'll be an important need to find a way to account for those issues going forward using fundamental principles. Very key issues going forward, but obviously, again, not necessarily ones that are particularly dealt with by FRS, but there'll be a need to be a way found to deal with them. And again, all will impact on the back end of financial statements in due course. So that stuff might seem a little way off, but it's all interesting food for thought, and all food for thought given very careful consideration by a very helpful paper published by the FRC very recently, FRS 102 fact sheet 8 on climate related matters, that goes the whole range of different accounting implications of some of the environmental issues currently around, and just explores the way the accounting might work and the issues that might present for accountants and auditors alike. Okay, so an introduction there to a range of issues. We've talked a bit about what it's all about, ESG reporting, environmental, social and governance. We talked about a couple of more close to home issues around section 172 and SECA and some of the common problems and some of the guidance there. And then a little look forward to some of the back end reporting implications with a link to the very recent, but very helpful fact sheet 8 published by the FRC, linking that in to FRS 102. Hope that was useful. If you've got any questions or queries in relation to today's session, do drop us a note at inquiries@insight-training.co.uk. And for our full program of CPD events, do check out our website, www.insight-training.co.uk. What you'll also find on the website on the blog and news section is our full program of CPD bite sessions I've run over the course of the last 12 months and our related newsletter articles. So do jump onto our website for all that resource. It's all there, all downloadable, and might be useful if you've not already had a chance to have a look at it. Hope that was useful. Thanks for listening. Look forward to seeing you all again soon. Goodbye.